Now entering the Bitcoin Podcast Network.
Today's episode is brought to you by KeepKey, the easy, safe, and simple way to protect your Bitcoin, Ether, Litecoin, and many other digital assets. There's no time like the present to protect yourself from hackers, malware, and viruses. Visit keepkey.com to order your secure hardware wallet today and use the code HUMANIST10 for a limited time 10% discount. And before I begin today's episode, a quick life update. I'm currently writing a book, which is exciting. It's about our exponential and fragile context and how crypto can help us smooth the transition through this digital revolution. So I'm not sure on the title yet, but I'll be posting updates through Medium and on Twitter. So check me out there, and hoping to have it done by the end of this year. So I'll let you know also through the podcast when that happens. Cool. So let's get to today's episode. Okay, so today's episode is with Lawrence Lundy, who's a partner and head of research at Outlier Ventures. And we talk about a variety of things, and I just want to kind of pull out three big points. The first is we talk about his convergence thesis, which states that IoT, AI, and blockchain will converge on top of a data substrate. And I mostly agree with it, and just two pieces of that. The first is that, it's good to remember that this is all mediated by trust as a primitive. And so you both need to trust the cleanliness of the data through the IoT device. The AI essentially creates a trusted conclusion given a set of data. And then blockchain clearly provides these trustless environments for ledgers and computation. And so trust is the key thing throughout this. Trust in the data substrate that exists. And the second piece here is that just a reminder that as everything trusts each other, then things begin to converge, as Lawrence says, and this is kind of a key piece of the future. And so, when I say, hey, we're in kind of a fragile time, given massive converging exponential technological change, the second word there is converging. And converging means that as everything trusts everything else, things both go faster and they start to converge and co-evolve with each other in these interesting emergent ways. So it's tough to say essentially what the long-term result of IoT, AI, and blockchain convergence is. So yeah, that's just to say convergence is a likely part of our future, and it's mediated by trust, and it'll make things faster and co-evolving and emergent. So the second piece here is something that we talk about is about the different kinds of venture capital allocation, and we place it in the form of competitive evolutionary allocation. So I think that this is just an important and powerful framework to place on your mind, where you say, hey, let's think about each of these different capital allocation mechanisms like VCs or ICOs or whatever as agents within a system, and they are agents that are competing and co-evolving with each other. And the question just to ask here is just to A, abstract to the level of the system, and B, to ask, hey, how do they compete with each other? Who wins in which context, etc. So I think that doing that kind of evolutionary biology mindset towards different kinds of non-biological agents like capital allocation mechanisms is a powerful framework. And then the third piece here I want to say is the fun part at the end of this episode is Lawrence and I just talk about like his life and like, a little bit of like humans and crypto stuff. This is something that I want to do more of, which is say, hey, I talk a lot about systems, but not that much about people, but everyone is a person and it's awesome and everybody's chill. Or most people are chill. Lawrence is chill. And so, it's great because Lawrence talks about his political background, his AI background, and how that kind of brought him into crypto as a way to decentralize power. And it's fun to talk about those kinds of things and not to concentrate on the systems the entire time. And so I like that, and I hope to do more kinds of humans and crypto and humans stuff kind of in general in the future. Okay, so with that, enjoy today's episode with Lawrence. Hello everyone, my name is Reese Lindmark, and you're listening to another episode of Creating a Humanist Blockchain Future. In this podcast, we take a systems thinking approach to doing good in the world, and we have a couple different series that focus on different system scopes, and today we're focusing on Series A, macro systems, where we ask the question, where are we, as society, headed? And today, I'm very happy to introduce Lawrence Lundy to the show. Lawrence is a partner and the head of research at Outlier Ventures, which is a venture platform that invests in the intersection of blockchain, AI, and IoT. Lawrence, thanks for being on the show and welcome.
Thanks for having me.
Yeah, excited to chat. So I guess, and there's a couple different strands that we're going to kind of pull on today. And the first one that I'd like to ask about is actually this kind of this thesis or this idea that you produced recently, coming out of the research that you've done about what you'd call like convergence. So could you kind of talk about what convergence is and how it relates to blockchain?
Sure. So the convergence thesis, as we spoke about before the podcast, not really a thesis, more than kind of an idea, comes out of work that really has been sort of, 4 or 5 years in the making, sort of percolating around, but really sort of coalesced, and we came up with a real concrete thesis about 2 years ago at Outlier, which originally was called Blockchain-Enabled Convergence. And that was a paper that we published I'd say two years ago or so, which we refined back at the beginning of this year, which we called the Convergence Ecosystem. And broadly speaking, it's our investment strategy, and it's what we invest in Outlier Ventures. And it's very, very simple, actually. Really, it talks about the new data value chain, right? So if we think about all industries and data being considered an industry, it needs to be produced, distributed, and then consumed. And the way in which we see sort of the emerging value chain around data is that data needs to be produced, and it's being produced in large amounts, driven predominantly by the Internet of Things, so-called IoT. And we see that at sort of at the bottom, right? That's where the data enters the ecosystem. And then we see blockchains broadly, distributed ledgers, and other new sort of decentralized innovations to be a new distribution layer to distribute, to secure, to manage, and to record a lot of the data that's being collected by the IoT. And once it's been collected, once it's been distributed, we see it going into sort of the highest level, and that's where the convergence with artificial intelligence comes in. And it's a very fluffy and woolly term, and we know that it doesn't really mean much. But what we're really talking about is consumption and automation of data in all its varied ways, from automation, which can include smart contracts, but it can just include traditional sort of big data tooling. So really, convergence is this kind of zone between IoT and blockchains, and then this zone between blockchains and AI. But broadly, the macro trend is this new emerging data value chain that we want to invest and partner with startups and projects that are building and executing in there.
Got it. Yeah, so it's thinking about, data as the new oil or something like that, and how data flows through the systems. And you have both the creation of data, and which is the production through IoT and various things like that, and then the distribution of that data through things like blockchains and other kinds of databases, and then you have the consumption of that data through AI and other kinds of machine learning platforms. So that makes sense. And I think an interesting thing with convergence that I think about is when I talk about the state of the world today and how we're kind of fragile from massive converging exponential technological change. The second word there, or the second adjective, is converging. And there's this weird, instinct that, in some ways, all the things start to collapse onto each other in a weird way, where it's like the things, because we want less friction, because we want more interoperability, then all of these things start to kind of play in the same realms, or to be able to connect with each other in various ways. Do you kind of, I guess, when you think about convergence, do you think about it in that way, or what are the things? How do you think about how things are going to converge over time, I guess?
Yeah, well, it comes from sort of the interdisciplinary thinking, really. And it comes from working with enterprises over the years, and governments as well to some extent, but seeing that everybody had a very siloed approach to how they thought about these technologies. And so you would have a department that would look into blockchain, or a department that would look into artificial intelligence, and then there would be a report written by one business unit, or there would be a government commission set up to look into one specific technology. And there was always a thought that you are never going to capture the full scope of change by just looking at one of the technologies in isolation, and that there was a far bigger macro trends occurring, and that's data. That's kind of the nub of it. We think it's data. So in any sort of new discussion around new business models and new economic models, you really got to think about how data is being used. And it was looking around and seeing that nobody seemed to have this interdisciplinary thinking, and that's not for want of trying. And there's plenty of wonderful academics and wonderful books and sort of people out there that are trying to consider this in a sort of very holistic way. Benjamin Bratton springs to mind when thinking around this. It's just that institutions, both from corporate as well as from startups, as well as from governments, are not incentivized to think in such broad terms and such wide scope. And so you just see a lot less of that thinking going on. And that is kind of what we wanted to do with Convergence, which we could have very easily come in with a model that said we want to invest in new capital market infrastructure, right? And lots of decentralized tooling. We want to invest in that. But actually, what we saw is there's this big converging sort of trend, numerous technologies, but also sort of the broad trend toward distribution and decentralization across sort of the political realm as well as the economic realm and the technological realm. And we wanted to sort of put a vision out there and say that this is our vision of a future. This is where we see things heading. And if you kind of agree or you believe in this mission as well, then we want to work with you. So that was kind of our framing and why we wanted to put this out there.
Got it. Yeah, I think, and a funny thing that you just touched on there was that in some ways convergence and decentralization are paradoxical with each other. But in fact, I think that if you kind of synthesize them, that they're actually, it's possible to say that something can be both converging, everything is converging around data, and kind of the decentralization distribution allows for that convergence to occur. So when you think about comparing your thesis to kind of other people in the blockchain and crypto VC space, how do you think about it as compared to others? How is it similar to people? How is it different than others? Kind of compare and contrast those theses.
I think that the first thing to say is we are right at the very beginning of this S-curve of this so-called blockchain industry. So we're right at the very experimentation phase, and depending on the frame that you want to use, whether it's an S-curve or whether it's the Carlota-Perez surge cycle, which I know Placeholder like to use, I think we're very much at the beginning. So it's worth preceding anything that follows by saying we don't know. And much of this is guesswork and is assumptions, and it's a vision of a future, but we don't really have enough data points to know. So with that in mind, the one thing that makes or we're able to do in this quite nascent industry, a function of the fact of tokens, which we may or may not get into, is that we can have a thesis that is a long way off. We can have a 10-year view because in this industry, as a venture capital firm or venture capital platform, you do not need to invest and see returns every year, and you certainly don't have to guarantee 5x, 10x to your investors and hold a project for 7-10 years. In fact, you can invest in a very, very ambitious project that might not see returns or might not see scalable market infrastructure for 5 to 10 years out. But it means that we can take that bet because liquidity is, can be 1, 2, 3 years out. So it means we could take different types of bets. Now, there are obviously trade-offs with that, but it means that this so-called Web3 stack or new convergence ecosystem means that as a capital provider, you can take different types of risks.
Yeah.
And that means that the way in which our thesis is different is I think that it's longer term. You sort of see maybe one confirmation out there really making some incredible investments in in tooling that's needed today, right, to build this infrastructure, and it is needed, and it's really, really important. And you might see a placeholder thesis, which I think, having spoken to Chris, and Chris contributed very kindly to part of the Convergence paper. And I think there's a lot of alignment in the way in which they're thinking around this sort of new Web3 paradigm and how we are. So I see a lot of crossover in the way they think about things, especially the importance of governance. And that's something that it'd be good to touch on later, because it's something very close to my heart. So I think there's a kind of a chasm between in the way in which I see sort of venture capital or capital being deployed in this market at the moment. It's either very near term, because we need to either invest in infrastructure to be built today, or we want quick returns, which we can also get today, and maybe not the last 6 months. But broadly speaking, the market is a new asset class for which it's a pretty good way to make money if you're a hedge fund, versus a few of the longer term players, the value add players like ourselves, and I'd also put placeholder in that group, and a few others, I think, that can afford to look further down the line. And that's good. That's healthy, right? You want different DCs, you want different time frames, you want different skill sets, all sort of taking different bets, because that's how this market will grow.
Yeah. I like that perspective, that when people talk about bubbles in a negative sense, they're like, oh, it's a bubble. Bubbles are by nature bad. It's like, well, actually, bubbles can create innovation, and you actually want there to be lots of kind of stuff thrown on the wall, and then depending, some stuff will work and some stuff won't, especially when you're at the beginning of some kind of trajectory here.
Hey, so, and yeah, exactly. And there's a real uniqueness to this market, which is that not only are there different investors taking different risks, there are, retail investors, or people that have put money into token sales and token generation events, or so-called ICOs, that are looking at very different features from projects. Mm-hmm. So traditionally, maybe, and for good or for bad, I don't necessarily talk about the specific issues of the project, but EOS is very unlikely to have ever raised that much money from traditional sources, or raised money at all. Who knows? But EOS has raised a tremendous amount of money. You have
we're going to get a lot of EOS people that are going to hate on us on Twitter. Watch out!
Oh no! That's the thing. I don't see it necessarily being a bad thing, but I don't think anyone could disagree with the fact that there are lots of projects out there that would not have traditionally either wanted or received traditional investment. Now that's a really positive thing, because you could argue, and I think it's fair to say, VCs or traditional investors overvalue certain attributes in projects. I would say they probably overvalue. I wouldn't say overvalue team, but team is very, very critically important, as a sort of traction, right? Traditional metrics that you can measure, user growth rates, or business partnership signed. Whereas in the sort of the token space, what's overvalued are technicals, and what's really undervalued are sort of go-to-market, right? Relationship with regulators, and have they looked at the value chain and understood exactly how they can add value and capture value. And that's really undervalued. So what you see are projects that might have traditionally been overvalued in the sort of traditional investor space, that don't get too much funding, and you could say that's inefficient allocation of resource, of capital, versus this new market where there are lots of very technical projects that wouldn't have previously got funded, but maybe not be able to get a clear sort of marketing strategy or a very clear customer acquisition strategy, that have got lots of money. Now, both, in my view, are inefficient allocation of capital, but they might end up with very different projects getting funded, and that's exciting, because who knows? You've got projects like Ripple going out and acquiring other businesses, even though who knows what XRP's use is in the system. But it might not matter, because they have a fund where they can go and buy other technology or acquire people, because they have so much money. So you have a really interesting new dynamic at play, which I think is healthy. And I broadly think that all experimentation is positive. and sort of as somebody that sort of wants to trust individuals, I think that we should give individuals as much responsibility and maybe not as much capital as they want, but certainly as much resource as possible to be able to execute on their vision. And we're seeing that in this market, but it is unusual because we're seeing things that wouldn't have previously get funded.
Yeah, I think it's interesting. I think that you can kind of think of them as new kinds of capital allocation schemes or what have you, venture capital, and then these new kinds of crowdfunding. And as you say, they can be kind of organisms that begin to co-evolve with each other and exist in a competitive environment with each other, where traditional projects might want to go one path, might want to go the other path, but giving them those options allows in theory more options for everybody and everybody to get better. So we'll see if that's true long term. Cryptocurrency is vibrant and exciting, but it's not without its share of bad actors. Exchanges and personal accounts can get hacked, computers can be infected with malware. Left unprotected, your digital wealth is up for grabs. Don't let yourself be a victim. KeepKey is the safest and simplest way to protect your Bitcoin, Ether, Litecoin, and other tokenized assets. This hardware wallet is a separate device that you control. Brought to you by the pioneering team at Shapeshift, KeepKey works with the wallet software on your computer to manage your private keys and transactions. Your device is PIN protected, which provides protection if it falls into the wrong hands. Its large display lets you carefully view and approve every transaction. And if your KeepKey is ever lost or stolen, you can safely recover your device without compromising its private keys. The bottom line, you'll sleep easier knowing that your digital wealth is safe and secure. Visit keepkey.com to order yours today and use the code HUMANIST10 for a limited time 10% discount. By that. So let's stay on this kind of venture capital and capital as a system thing. And one thing that I find very interesting with Outlier is that you all don't have a traditional LP relationship. So for example, when I had Gary Tan and Kembai Cutler on the show recently from Initialize Capital, and with them we were talking about venture capital as a system and how it's sad sometimes when a venture capitalist wants to fund something, but they also need to get 10x returns so that they can give that to their LPs, and that you kind of have this incentive system, this kind of layered hierarchical incentive system that's all kind of like LP ROI driven, while your incentive system is this interesting new LLP relationship. So could you talk a little bit about what is that LLP relationship and what kind of incentives does it bring to your team?
An LLP is obviously not necessarily a new corporate structure, but it has certain trade-offs, which everything in life's a trade-off. So what it tends to mean is that an LLP, you can only invest your partner's money, and it's a structure that tends not to be used in venture capital, because you can't go out and raise sort of 300, 400, 500 million pounds from institutional investors like pension funds, because each partner is contributing to the business. So what you do have is you have, the trade-off is having less money, but having a group of partners that are all aligned, it's your own money, so you have a skin in the game. You therefore don't necessarily have capital holders which are demanding a certain return, because to them it's an investment and a new asset class for which they want to see a return. It means that we as partners at Outlier Ventures, if we're aligned with our mission, if we're aligned in our views, then we can invest in a project knowing that we're not going to see any return in 10 years, or which I think is equally exciting, we can make investments that we may all know will not yield 5 to 10x, but we believe that the project or the protocol generally has such great potential and so foundational to what is required for this new emerging data ecosystem that we will contribute our time, our capital, and our resource regardless. And I think that opens up a whole new range of opportunities that have previously been ignored. And personally, I think that's why this idea of blockchain for good is so prevalent, and why sort of the Pineapple Fund is a good example. But there are numerous others. I think that's why you can start investing in social philanthropy. You can start investing in, self-sovereign identity projects is another good example, right? Self-sovereign identity. Identity is such a fundamental human right, but also it's to some extent between the physical and the digital worlds. I would go so far as to say it's broken. And identity, you try and get if you're going to say to a normal investor, what return are you going to get from investing in an identity platform? Well, quite frankly, who knows? But we know that it's so important. It's so broken in the existing sort of nation state system that we want to contribute our time and our resource to helping and making that happen. So it kind of opens up new opportunities that might not normally be seen as lucrative opportunities. And it also means when we are investing our resource, and by that I mean capital generally, it means that we are so when it's your own money, of course, you're obviously a lot more involved, and you want to be more involved. So what's happened as a function is that we actually invest, a reasonable amount of money, but in terms of capital as a resource, actually it's our time that really we put more into. Mm-hmm. So we might find with a project that, I don't know, 90% of all our partners' times are spent in a specific project. So we've invested capital, but then, of course, you might say you're a value-added investor, and everybody does say we add value. But there's no other better way of adding value than when it's your own money and you truly believe in the project. Then, of course, you are incentivized to give more of your time and more of your resource and more of your capacity. And that's what we find. We find we're no longer constrained really by capital deployments. We're actually constrained by our own time. Yeah. So there you go. But then, of course, the trade-off is, there's not a 300 million fund, and it's probably over time less scalable. Mm-hmm. And so there's obviously ways in which you can think through ways of raising more money, or other ways in which you could partner and build a larger ecosystem and have a larger impact. But we think that the incentives that we have has enabled us to be part of some really tremendous projects. And of course, as we grow, there might be different trade-offs that we make because everything's contextual, right?
Yeah, that's interesting. I think, as you say, there might be different kinds of capital structures that may make more sense in 5 or 10 years. But as you say, right now, especially when you're investing on such a long time scale, that this kind of formation structure is relatively helpful. It reminds me of a couple things. It reminds me of kind of angel list syndicates or angel investor syndicates where you kind of get together with a bunch of people and say, hey, we're going to invest our money in these ways. It also kind of reminds me of someone like Joseph Lubin at Consensus, where he's essentially a one-person LLP or whatever, and he can invest in these kind of long-term timescales and just invest in lots of infrastructure, MetaMask, Truffle, Infura, or whatever, knowing that, as you say, that ecosystem, and it's both. You can think of it either from and we've chatted about this a bit on the podcast before in past episodes, but you can either invest in something because just purely for good and invest in infrastructure for good. You can also invest in infrastructure because you know that kind of infrastructure is essentially necessary for the other parts of your ecosystem to work. So for you, investing in an identity platform, or for, Joe Lubin investing in Uport or Truffle or what have you, is necessary for the rest of the Ethereum ecosystem to kind of grow, or for you, the rest of the Convergence ecosystem to kind of actually succeed. And so I think we'll see those kinds of, it's a new kind of previously we only saw us kind of investing in kind of platforms where platforms would invest in, different parts of their platform because then they would get the returns on that capital or whatever. And now we're seeing it at kind of a deeper infrastructure level. So I think it's good. Do you think, by the way, that it is, so when you think of, so you're thinking about stuff on a long-term time scale, and you don't necessarily you can discuss with your partners in a more kind of person-to-person way about what kind of returns you expect from specific infrastructure. Do you think, is part of that also connected to values or kind of like ideology at all? Tell me about that kind of more human piece.
Yeah, I think it has to be. I think every single individual broadly is motivated by different things. I think there are obviously some themes, and in any organization, any structure, you'll find people that are motivated to different levels by different things. But I think it's definitely true of Outlier. Jamie, Burke, and Aaron, the sort of the co-founders, definitely there's a motivation there beyond just it being a asset class. And I think when they founded the company 4 or so years ago, it wasn't a new asset class. It was really interesting technology that offered new, I'd say, decentralizing potential. And of course, Bitcoin being the first and still the largest, and maybe in the end, maybe the largest, who knows? But they saw a potential for quite a game-changing power structure technology. And my own journey to this is actually through artificial intelligence, interestingly enough. As a previous sort of career, sort of a researcher in artificial intelligence, and it became very clear to me, and I guess this would have been 4 or 5 years ago now, it became very clear that the way in which the winner-take-all effects from data, or at least data network effects, and then the winner-take-all platforms that emerge from that, have very profound consequences for the consolidation of data, therefore of markets, and of profit and power. And that might sound abstract, but I think once I sort of came to that conclusion mentally, I realized that it was important that the technologies that we built and the tooling that we built took into account the market and the social impacts. And that is where blockchains come in for me. They come in as a rebalancing technology, or as a tool to prevent, I would say, the consolidation of power. And that's why I've always had quite an abstract view on this space. For good and for bad, but always had a view that it's not a specific implementation of blockchain. It's not Bitcoin, it's not Ethereum, and that's not to say I don't love any of those technologies, but it's actually the broader characteristics of the technology which can act as a balance to, and I'll use the word tyranny, because I think that's ultimately what I drive at, is tyranny. It's consolidation of power, and tyranny can be through government structures in sort of a nation state, but tyranny can also emerge from corporate structures and from corporations. And so that is a very explicit political motivation of mine. And I think within the organization, people would articulate a similar-ish viewpoint. And I think that whenever we're debating new projects, new investments, new partnerships, it's always with that lens. And that lens is, we're not only going to consider projects that are going to offer the best return. We want to make sure that we're investing in infrastructure that is diverse, that is considering the implications on society, that has a very clear vision on what they want to achieve. And the importance of the mission is just as important as it is a good investment. And so, we're attracted by projects like Sovereign and like Ocean. That's another really good example. I won't run through our whole portfolio, but that you'll see from all the investments we've made that there's a very, very clear social characteristic in the way in which we make our investments.
Yeah, that's interesting. I think that there's and I mean, if you can imagine a founder, like a blockchain founder, coming to you and being like, hey, I want to make a lot of money by making this thing that's going to just like extract a bunch of rents. And you're like, oh man, I don't know if that is really, and like you want to centralize power, and as you say, that would not be value aligned. So that would be a very clear, even if they're building great stuff, it's like, I'm not really sure if this would be good for the world. I also think that it's interesting that different people come at it, as you said, you came at it from the kind of the AI lens and saying, okay, we have these massive aggregators like Google and Facebook, and if they have these data silos and they get control of those data silos and control over how AI operates on that data, then they're going to have lots and lots of power, and that's probably not good for society. I think that perspective is one that people often come into it from, and then the other one is from like a financial perspective, like after 2008, 2009, saying, oh man, we have a fragile financial system, how can we decentralize the power in that as well, and stop corruption and stop tyranny there. So I think so many people, everybody's different path down the rabbit hole. I feel like they often start, the people who stay, I guess, their paths down the rabbit hole often are based in something like the decentralization of power rather than something just like speculation.
Yeah. And so, yeah, just to add to that, again, it gives a little bit more context behind, I guess, my motivation is even before that, my background is political. And just strangely enough, I studied the devolution of power from UK Parliament to Scotland, to the Scottish Parliament. And devolution of power is just one form of devolution is one type of distribution tool, and sure, it's not technical, it's not technology driven, but it's the same questions, right? And the same questions, whether it be just Parliament and the separation of powers, in the US or in the UK between the judiciary, the legislative, and the executive. There is a separation of powers for a reason, and that's to limit the undue power of the executive or the king or the monarchy. And we've built infrastructure, we have constitutional furniture that's built and checks and balances to prevent the consolidation of power, especially around the executive branch. And we have, and nations have gone through this nations have got, people have gone through it for millennia, but nations have been through it for hundreds of years. Yeah. And I don't think the questions are any different to what we're asking today, and what we say when what goes on chain and what goes off chain, and who decides the product roadmap update, and how improvement proposals upgraded. All of these questions are the same questions. They're essentially saying, how are we preventing individuals from having undue influence, or groups or cohorts of people undue influence over a network? It is exactly the same question that we've struggled with for millennia, just with a very technical focus now.
Yeah, I agree with that. And we have new, blockchain has given us new affordances. Blockchain, IoT, and AI have all given us new affordances and new lenses through which we can answer that question. So I guess to kind of wrap up here, there are some projects that you've been excited by recently. You have here Foam, you have Interledger Protocol, but one that I actually don't know very much about, which I would love to learn more about, is Codius. Could you tell me about what is Codius and why are you excited about it?
Well, yeah, maybe I don't necessarily need to back up, but rather saying that one of the most interesting areas of exploration for me is interoperability. I mean, it's something that we look at Outlier a lot, and we're always looking for projects that enable interoperability of code or data. And in the case of Codius, it's smart contracts or smart programs, really, and that's pretty much the context of it. So again, the reason why I'm excited is because it's open source, and that's pretty critical to all of our investments. I think it's important that these are seen as projects, and any code that's built, any tooling that's built, can be shared with the world and can be improved upon by anyone. That's pretty critical. But what I don't want to see in this new sort of stack, the Web3 stack that we're building, is that we end up with the same data silos that we want to tear down. So a lot of focus has been on the sort of the blockchain layer, and you sort of have your Cosmos and Polkadots and Aeons that are trying to enable blockchain to blockchain interoperability and value transfer, and that's critical, and we will need that infrastructure. And to me, there's been a neglect on the sort of database interoperability part. And that's where Higher Networks, one of our latest investments out of Berlin, they're focusing on enabling databases to interoperate, and that's that's going to be pretty critical. And their first application that is Orbit DB. But Codius is the logic layer, right? It's the smart contract layer. So let's say we enable databases to be interoperable and data to flow more easily across databases. We have lots of interoperability tooling for blockchains, and we could still end up with the same dynamic that we saw with Web 2, where the application layer ends up capturing the data and having outsized influence. And I think there's a risk that would happen on smart contracts. And that's why I'm really excited what Codius are building, which is, interoperable logic, interoperable smart programs or smart contracts to enable the application layers to share execution data. And I think that's going to be pretty critical component of tooling. And then obviously after that, you ask, well, oracles, how do we make sure oracles are interoperable and decentralized? And I think you basically, the whole theory is that we need to avoid bottlenecks of outsized value capture. And at the moment, the risk is that happens at the smart programs. But I think that with Codius that can really help open up that. And so that's what I'm really excited about. And just, it's, really, really great technology, which is obviously one of the most important elements to a lot of the projects that are out there.
Yeah, that makes sense. You can be excited by, and then as you're saying this, it's like, let's make interoperable protocols all the way down, turn everything into a protocol, turn everything into a pseudo, commodity of some variety. And as you say, how can we do that also at the smart contract layer? And then, as you say, going deeper, what does it look like for oracles, etc. And then in addition to that, you can have that idea, but then you also clearly need to have the tech that backs up. How does that actually work? How does smart contract, interoperability actually work there? So that sounds exciting. I will check it out more. So with that, Lawrence, thank you so much for your time. We're out of time right now, but thank you for coming on, chatting about both Convergence, venture capital kind of incentive structures, and then also Codius. Where will people be able to find you on Twitter?
Well, very good question. I'm trying to use Twitter less.
Oh, nice.
Yeah, I know. I feel that I'm trying as much as possible to avoid using social media, try and get some thought time back. But anyway, I am always reachable at Lawrence Lundy on Twitter. I'm trying to disengage a little bit, but do find me on there. Or you can contact me directly through the Outlier Ventures website. It's outlierventures.io.
Boom. Okay, great. Either of those. And I agree with you that we should all probably tweet just a little bit less. And if you want to support me, by the way, listeners, you can go to patreon.com/Rieslandmark. That's patreon.com/RHYSLINDMARK. Okay, great. Thank you so much, everybody, and goodbye.